Now we're going to talk about financial statements. And one of the required statements for a company now is called the income statement. And I don't usually like acronyms, little abbreviations for everything, but it's very common in textbooks. So I'm going to put here what are the common acronyms for various pieces of the income statement and explain it to you. Now, just in the big picture now, income is what we call a flow variable. And to understand income, you have to understand the length of the flow. If I told you that my income was $20,000, you wouldn't be very impressed if that was $20,000 per year. On the other hand, if I made $20,000 per week, you'd be a lot more impressed. As an analyst now, you always have to know how long the flow of the income is. It's very easy to determine. You glance at the top of the income statement and it'll tell you something like, a statement of revenue or statement of income for the year, or a statement of income for the quarter, or whatever time period it is. Now, that's very common, and when you are an analyst, when you're analyzing a company now, you have to make sure you're comparing annual statements to annual statements, not quarterly statements to annual statements. And again, this is going to be an important distinction. It's very easy to figure out what the length of the flow is, and again, just glance at the top of an income statement. Now, the item that's at the top of a income statement is usually sales or revenue. Now, is there a difference between sales and revenue? Well, technically, yes. Revenue denotes cash, money. Sales, on the other hand, can be cash sales or they could be credit sales. A lot of textbooks use revenue and sales kind of interchangeably. Just so you know, technically there is a little bit of a difference between them. But again, I want you to understand all of this. After sales now, you have the costs, what are called the operating costs of the company. Variable cost and fixed cost. Now, total variable cost, TVC, fixed cost, FC. Now, these are the operating costs of the company. Variable costs are costs that fluctuate with sales, with revenue. You can imagine that if you were a production facility and we were making blue shirts, the electricity that it would take me to run the plant to make 1,000 blue shirts would be different than the electrical cost, the utilities, to make 10,000 blue shirts. As utilities go up and down, revenue tends to go up and down. And again, that's an example of a variable cost. A fixed cost, on the other hand, is a cost that remains the same no matter what revenue is. And a typical example of this would be the lease on a building. I mean, if I lease this room to make our blue shirts in, whether I made 1,000 blue shirts or 10,000 blue shirts, the lease on the space is still whatever it is, $2,000 a month. So that would be an example of a fixed cost. So variable costs tend to vary with revenue, with sales. The fixed costs, they tend to stay the same over different levels of revenue and sales. But if you take sales and you subtract out your operating costs, that is, if you take sales minus your variable cost minus the fixed cost, you end up with something called EBIT. Now, EBIT and operating profit are the same thing. A common mistake I see students make, they think EBIT is earnings before income taxes. That's wrong. EBIT stands for earnings before interest and taxes. And it's also known as operating profit. Now, this is an important level of earnings for a company because the next thing is the interest expense. This is the interest on your debt. Operating profit, EBIT now, that's the earnings available for paying the interest on your debt. And if you can't pay the interest on your debt, they call you bankrupt. That's one of the technical definitions of bankruptcy. You can't pay the interest on your debt. So having enough operating profit to pay the interest on your debt, this is a very important thing. We'll talk about EBITDA and interest later on when we get into financial statement analysis, but for right now I want you to understand that operating profit, EBIT, that's the earnings available for paying the interest on your debt. That's why that's an important level of earnings. If you take your operating profit, your EBIT, subtract out the interest you owe on your debt, you're left with earnings before taxes, EBT. This is also known as profit before taxes, taxable income. Those all mean the same thing, okay? We're going to call it earnings before taxes. It's fairly descriptive. And again, that's the earnings you have before you pay your taxes. The next item on the income statement is taxes. These are the taxes of the company. And if you take your earnings before taxes and you subtract out your taxes, you're left with net income, sometimes referred to as net profit, sometimes referred to as earnings after taxes. Commonly, it's called net income. There's only two things a company can do with its net income. It can either pay it out in dividends or it can retain it in the firm. Now, the first dividends you would have to pay would be to your preferred stockholders. If you have preferred stock and you owe the preferred stockholders a dividend, that's the dividend you pay first. That's called preferred dividends, PD. Net income minus your preferred dividends now, that's the earnings available to the shareholder. Technically, the earnings available to the common shareholder. We're the owners of the company, that's our money. We determine how much we pay out in dividends to ourselves or how much we retain in the firm.